Ladies and gentlemen, it's a pleasure to be here this afternoon. I was interested sort of reflecting on some of the comments on the previous panel and hopefully there's a bit of a read across to some of the things that I'm going to say. We've already heard a little bit about sort of headwinds and what's going on in the capital market. So I was just going to give you a really quick snapshot about what's happened over the last couple of years. The first thing to say is that since the pandemic hit, we've had over £100 billion raised across AIM, our growth market, and our main market. So there is plenty of capital, there has been plenty of capital, and investors have wanted to invest for the long term. I know I'm talking about IPOs today, but it's worth remembering the IPO is just the first step in the next stage of a journey. And we often see in any given year, 80% of the capital that's raised is by companies on our market going back to their investors and raising follow-on capital. And so, the public market served a whole range of companies very well during the pandemic, not just the FTSE 100, but also our smallest companies on AIM. So 2020 was very much a year of sort of further capital raisings. Last year was very much a year of IPOs. So last year we had the strongest number of IPOs since 2007, 126 IPOs. Again, they weren't just the largest companies. You will have heard a lot of those names in the press. But 66 of those were relatively small companies on AIM, our growth market. We had a really strong growth in the number of tech and consumer internet, so 40% of companies that IPO'd were tech businesses last year. And they were right the way across the market cap spectrum, from small AIM companies through to some of those names like Deliveroo, Fixed Price, Oxford Nanopore that you can see on the main market. So this year, clearly, globally, market conditions have been more challenging. That's not to say the markets are closed, though. There's been a lot of commentary about valuations, particularly in North America, having fallen quite significantly over the last sort of 2 or 3 months. We've had 30 IPOs so far this year in London, so there is activity. The amount of capital that they've raised has been lower than last year. But investors still want to see growth stories. And to a point that was made earlier, I think over the last sort of decade or so, actually, European institutional investors have been a little bit more conservative. And that's meant that actually they've quite often been sat on capital and dry powder when there have been a sort of downturn in market conditions. We saw that pre the pandemic, so there was then plenty of capital to deploy. Again, we're hearing that at the moment, that investors have got capital for the right businesses. I think there are a few messages I'd really like you all to leave this session with. One is that an IPO might feel like a very distant prospect, or that it's somehow really scary, or that it's only for the largest companies. And I think that final view often prevails because we often hear commentary about, the FTSE 100. What's the FTSE 100 done today, or the FTSE 250? One of the very unique things about the London Stock Exchange is that we offer a range of markets. We offer AIM, our growth market, as well as our main market, so we can genuinely support companies from low tens of millions of pounds up to multi-billion. So don't put it off thinking you've got to be a huge business. The other thing is that, and we heard a little bit of this on the previous panel, don't wait, whether it's an IPO or any other form of finance, don't wait until the time that you need that finance or that transaction to start planning. One of the things with a lot of the most successful IPOs is actually the founders, the management teams, have often had the goal to IPO, or it's in their mind right the way through their growth journey. And what that's often meant is that they've kept their cap structure relatively straightforward. They've put governance, they've put management information processes in place to actually be a better company, which has served them better when they've raised private finance. So, a lot of the key components of an IPO actually are very simple, and they're very similar to other forms of finance. So don't view it in isolation. The third thing is that I think sometimes the capital markets may feel a little bit faceless. And one of the reasons that we're delighted to host you all here today is actually there are lots of us who are very prepared to come and have a coffee, have a conversation about the opportunity. So sometimes, I meet companies who I think they're almost a bit scared to engage with, their accountants, their lawyers, a bank about an IPO process because they somehow feel like they're going to lose control of the process. Well, that's not the case. Across my team and colleagues at the exchange, but also a lot of the advisors are willing to give you that free, information and just have a coffee with you. So think about that as well. Julia sort of touched upon this earlier. The capital markets don't operate in isolation. We see companies IPOing on our markets, AIM, our main market, being taken off our markets and being bought back by other corporates, by venture capital, by private equity. We see transition between our markets, companies moving from AIM to the main market. Quite often companies come to our markets and IPO, ultimately with the view to be acquired, knowing that actually doing the IPO will raise their profile and their visibility. So it's not a sort of a one-way street or the end of a process or necessarily an exit. It's often just one of those stages in your growth journey. But for us, making sure that all of those stages are well joined up is really, really important. So why go public? Well, often it's to raise capital. I started my remarks this afternoon about the depth of our markets. A lot of companies over the last 2 years that were dependent on a very narrow set of investors or private finance, or maybe they were in a venture capital portfolio that was 7 years into its 10-year life, found that actually their ability to raise capital was constrained by who their investors were. Hence the comments on the previous panel about really understand who your investors are. The beauty of the capital markets is there's a very diverse range of not just UK and European investors, but global investors from retail to the biggest pension funds. As I was mentioning earlier, the IPO is not an activity in its own right. It's often just the first step that then enables you to be able to raise further capital much more quickly and much more cheaply than other forms of finance. But there are lots of other softer benefits to being public. The number of times over the years companies have said that even within a short period of time post their IPO, their profile, their visibility and their credibility has been higher, not just investors, but with customers, employees, suppliers, and that it's been a lot easier to win contracts as a public business than a private business. And that's because people, not just investors, but corporates have faith in the IPO process, the diligence process, and the companies that have been through that. Clearly, having a share that's publicly traded is a great way to incentivise, to keep and retain staff, but also to be able to use your paper to make acquisitions. Also, this point about we came up on the previous panel about equity not being a form of finance in isolation. Again, many companies will often say that post-IPO, they manage to get their bank finance on much better terms because it gives confidence to the bank. So there are lots of advantages to being public. So as I was saying earlier, we operate a range of markets, AIM, our growth market, and then our main market, which people often associate with the FTSE 100, the FTSE 250, is split into premium and standard. You can just see along the bottom the types of companies that come to our markets, from relatively small businesses on AIM through to the likes of Deliveroo, Oxford Nanopore, that took a standard listing, and then some of the largest businesses, the Sages, the Just Eats of this world, on the premium segment of the main market. I won't dwell too much on that slide. Going back to the point about being regular users of the markets, this slide just gives you a snapshot, first of all, of not just how companies grow, like ASOS, that was an AIM company until it transferred to the main market a couple of months ago, that came with a market cap of 12 million and now is valued at just shy of 2 billion. But also, made 5 acquisitions, did 9 follow-on capital raises during its time on market. Keyword Studios has done 52 acquisitions. And, that ability to use the markets for investors to support companies, really is something that, you should think about. Because, investors want to see that growth. They're prepared to provide capital to fund acquisitions and growth. So, just quickly, just to wrap up on AIM specifically. AIM's our growth market, over 800 companies, all sectors represented, £130 billion raised since it was launched. It's a market for all sizes of companies, so you can see companies valued below 10 million. The majority of companies are valued between about 50 and 500 million, but also companies come and stay on the market. So, we've got companies that are valued into the billions of pounds. And in the same way that main market companies can repeatedly come back to the market, so can AIM companies. And we often find actually for some of the larger technology companies that 40% of their shareholder register can be North American institutions. So it really does provide access to a very broad range of institutional and global capital. Last year, of the 66 IPOs, again, just very quickly, they were across the market cap or the valuation bands, as was the further capital that was raised. So very, very broadly spread. And across a broad range of sectors. Just to sort of finish off on the valuation point in the UK versus the US, there are a lot of misperceptions about the US market. I've already mentioned that actually North American investors are very prepared to invest in the London market. So what you actually find is that valuations get arbitraged out. If an investor sees a listed company in London that's undervalued, they will invest, and so that valuation differential gets removed or eliminated. I think the challenge, though, is that quite often people don't compare like with like. So they will look at a US-listed business or a US private business that might have 40, 50% annual growth and compare it to a UK business that might be in the same sector but that has got very different growth rates or potential. If you actually break it down and look at companies like for like, valuations actually in London are very, very similar to the US. Irene.
Marcus, thank you very much for that whistle-stop tour. May I invite Terry Coutu, our Scaleup guru. We're just going to talk now a little bit more about the journey to IPO with two Scaleup leaders. Terry Coutu is the founder, frankly, of the Scaleup movement, a serial entrepreneur, non-executive director here at the Stock Exchange, and has seen it from all angles. I mean, the founder that IPO'd a number of years ago, the investor that's seen many companies invested in IPO, and now also on the board of directors of a range of them that are IPOing and going to the primary markets. And Sarah Howell, who is one of our leading life sciences businesses, Arecor, which just floated in July 2021, so right in the middle of the pandemic. So let's start with you, Sarah, in terms of your journey and some of the reflections that the room has had. What, for you, has been that journey of deciding you did want to float? And what were the triggers? And what lessons have you learned from that process?
Okay, a lot of questions. Yeah, so I think, for our journey, I think some people mentioned it earlier on the panel, it was always on the horizon as a growth company. So, we work in the healthcare space, which can be relatively capital intensive as well. As a business, we have a mixed model in that we partner with pharma, so we are revenue generating, which is in some cases slightly unusual under a technology licensing model, but really we're looking for additional capital to go through clinical development for our own proprietary products in the diabetes space. So, there was always a horizon, although we hadn't put a time frame on it, to think, well, actually, moving on to the public markets and being able to access that pool of capital would make sense at the right point in time. And I think Sonia mentioned it a number of times in the last panel. So we were ready. We were ready for either fundraising or IPO, which, essentially you're raising funds there. And that was absolutely critical for us because the decision in the end to IPO last year was made very quickly. We were gearing up to do a private raise. And then we really sat back and said, actually, the markets are very much open at the moment. I think one of the impacts of COVID for healthcare and biotech tech companies was that there were there's good quality investors and capital looking for high caliber biotech and healthcare companies, whereas they might not have done so in such numbers previously. So I remember we sat in a board meeting in January last year to say, and really I went to that board meeting to say, why don't we IPO? And it went from there to us making the decision in February that yes, we would. And then we got that IPO away in June last year. So it was quite a condensed process, really, to do that. And we were able to access the capital that we were looking for. It's slightly oversubscribed, which was great. And, it was a very streamlined and relatively quick process. And I think, Marcus, you mentioned that around those time frames, is that it enabled us to, it was an intense period of time, there's no doubt about it, but it enabled us to access that capital quite quickly and then get on with running the business, essentially.
And what have you seen as the benefit since? Did you take any lessons from the process that you would have done differently?
I think, being ready, there were a number of things because, it was on the horizon to do at some point. So I brought on board a very experienced CFO who had experience across public and private sector markets in 2019. And prior to that, finance was management accounts outsourced to a group, and then I did everything else. There's absolutely not a chance we could have IPO'd without a CFO. So I'd say, you really got to look at your team, not just, Susan and I, who's just CFO, did most of the heavy lifting through the IPO, but the business continued to deliver. So you really need a strong management team in place that understand that you are literally going to disappear for about 3 or 4 months and then come back and be on their back of where are we? We've got to deliver all of these things because, you're very publicly making promises to your investors and the market around what are you going to deliver and what your value inflection points are going to be. So you need to be sure that when you dive back into the business, you're not going to get any horrible surprises. So, we had a good management team in place that kept the business moving, which meant post-IPO, there was a number of key milestones like clinical data that we delivered on time and to market expectations, and I think that's been
Sarah, that's
key.
A great segue into Sherry and your reflection. Sherry, you've just actually come from a session talking about talent in scale-ups and sharing that. You've been in this market a long time. Just earlier in the conversation, there was a lot of discussion about UK versus US. I mean, what's the perspective you give to the audience who are thinking about fundraising in their different ways and even maybe considering, is IPO right?
Okay, so in terms of UK versus US, I've got a strange background in that the first company that I floated, I did a dual flotation on here in NASDAQ. Since then, I've floated 2 other companies on New York Stock Exchange. Very sorry about that.
So we're still talking.
They were American-based. We're still talking. But I do think that you should think about these things, and you should think about these things, and what is right for you, and what is right for your business. We do as a stock exchange compete with some others, and they've got other products. But I think looking at, and I thought one of your slides illustrated it brilliantly, which is you've got the entrance, and it's called a market entrance for a good reason, and illustrating the support that you give for other capital raisings and for acquisitions and for product development is a really important part of why you float, because it doesn't end there. And I think often you can think it ends there, but it really is the entrance, and I think that's super, super important. So what support is there? I thought you didn't mention flow, or not much, or at least not when I was in there. They were in the panel,
So
okay.
Data was mentioned a lot, Sherry. Do you want to mention data again? Because
Data's very, very important. Oh, yeah. Oh, okay, cool.
Data.
So I think the extension of the entrance and the sort of mapping people on so that they're prepared for flotation is really important, and the data and the information is critical. And I think that we do have differentiation on that. You were talking about talent. One thing that I would add on to what you've said is you do kind of, as you're going into that intense period when you've made the decision, and often you'll dual track a capital raise and an IPO at the same time, which really does mean you can disappear. So isolating who do you keep focused on the company is really, really important. And I think making sure that your operations and product, maybe it's your CTO, maybe it's your product, make sure that they're well supported and okay for you kind of almost exit, because it is an all-encompassing thing. So your bench strength has to be excellent. Your data rooms have to be absolutely right. So again, get ready is really important. One thing that I found really helpful for me, and I don't think we would have floated if I hadn't done it, was I joined the board of a public company 2 years before I floated my company. And also encouraged the other sort of directors at my company to do the same. And getting into that mindset and understanding and having respect for the corporate governance and what it allows you to do and what proper board governance is was really helpful. I didn't have any understanding of how much I wasn't helping my NEDs before I joined a public board. And boy, did it change my behavior as a chief executive. And boy, did it change their ability to leverage and to add value and to help us as well. Talent, we've got the development of the talent that's on your team already, so that the wheels don't fall off the bus post, because if the wheels do fall off the bus right post an IPO, it's really not at all helpful. So being clear that there aren't any disruptions. We've had disruptions on supply chain in a number of markets at the moment because of wars and the pandemic and everything else, and that's not very helpful. So is yours a type of business that's going to be able to withstand that and not disappoint the market? If so, excellent. Let's get talking. And if not, maybe just think about whether or not now is the right time. Somebody mentioned 6 months versus how long this nuclear winter that we may be entering or have just entered is gonna on the last panel. And I'm hearing more 24 months to 36 months just in the last month or two. I don't know how bad it's going to be, and nobody does have a crystal ball, but 6 months I think would be incredibly optimistic.
But you should still plan and get prepared for what that.
You should still be ready to go the second the window opens back up. Then be ready to dive through it. I think that's really important. But it could be quite ugly. But there are trillions that are locked away in VC funds that have been raised already, there to deploy. And if you're certain, and then I would go after that, because they're very hungry and they're under pressure themselves to deploy that capital rather than sit on it. So there's that tension, but this uncertainty is unpleasant.
Marcus, I'll come back to you in a minute. Is there any questions from the audience at the moment? Anybody want to raise a question here? We'll keep them for later. Okay. We're going to go into a short break. There is a lady there.
There's a mic.
A quick question in terms of the EIS and how important EIS, and actually do you feel that current regime for EIS is supportive enough in terms of innovation, especially for existing businesses?
Marcus, do you want to take that one?
Yeah.
You and I talk about this quite a bit.
So, look, there's always more that could be done, but actually I think we shouldn't lose sight of the fact that we've got a very comprehensive and well joined up sort of package of tax breaks, whether it's EIS, whether it's the VCT scheme, business property relief. And actually, I think it raises a really good point. That's really embarrassing. Particularly in front of my colleagues and non-exec. So one of the big benefits of us operating AIM and the main market separately is their regulatory kind of classifications are different, which means that a lot of the tax breaks that apply to private companies also apply to AIM companies. So that really helps businesses sort of transition. EIS, we often see actually the VCT schemes and the VCT managers acting as cornerstones, both in a sort of crossover capacity as pre-IPO investors, but then being that cornerstone at the point of IPO. Similarly, we have a lot of companies where the founders are sort of thinking about some of their long-term planning and not wanting to exit the business or sell it, but thinking about inheritance tax and business property relief. So I've gone slightly off at a tangent, but I think we have got a very good package of tax breaks. One of the things that Irene, Sherry and I are often talking about is not losing sight of how good they are and protecting them, because sometimes I think there's you can take them for granted. I think there have been changes about knowledge-intensive companies, and there's possibly a case to be a little bit more lenient around some of the minute thresholds.
Yeah, and I think that's that whole continuum of capital we talked about earlier from angel right the way through. So we're coming up to break time.
Just on the angel, I think it does release a lot more angel capital for the earlier stage, which means the transition from very, very early into getting ready for scaling is easier because of EIS, and other markets across Europe don't have that. So I think it does give us a competitive advantage.
And it's definitely driving more angel investment around the country, which is so important, which the British Business Bank is also working very closely on.
I know you're desperate to get off.
We're not. I don't want to, because the only reason, Marcus, we're running through this quickly because I can't not be on time for market close. So that's the thing that we're all. There's a bit, and apparently that we're not allowed to actually extend the deadline for that. But carry on, Marcus. I'm coming back to you all.
On the regional point, one thing on the regional point, actually, I think one of the really positive outcomes of the sort of the pandemic and the use of technology was, we've seen a lot of those regional barriers sort of break down. So, last year from an IPO perspective, we had Scottish, North East, North West businesses, partly because, it's now possible to do a completely virtual IPO roadshow without having to, trek all the way around the country and give up weeks to come and see London and Scottish-based investors.
And I think also importantly, Marcus, you've got a regional team. A number of that team is going to be around later today for everybody to talk to. So that's really important. Sherry and Sarah, I'm going to have the ladies have the last word on this panel. So, Sherry, one killer piece of advice you'd like to give to our scaling businesses in this room? Words of wisdom?
Focus on your customers. They're a great source of cash as well, particularly at the moment. But go for it and talk to your peers. This is not scary. There are a lot of people who have trodden down this path before, and they want you to be as successful as you are. So if you're feeling alone sometimes, don't feel alone. Reach out. We can connect you to others, and just go for it. It is rewarding, and it's a great thing to do. And there's a lot of people that want you to win.
And Sarah, Arecor?
I would say, really think about the story, actually, and what is that growth story? How are you going to articulate it, whether you're looking to private investors or IPO? I think as you're private, think about your investor base and select them carefully to think about how's that going to evolve. We talked about crossing over onto the IPO, share structures, make sure it's not complicated because it's all going to have to fall out if you IPO. So I think that's really important to think about that structure. And I would say, one piece, it was a very intense process, but I went to lots of these kind of events, and I was in the Elite program, and every time I came away to something that was people talking about IPOing, I just thought, oh my God, it sounds like an absolute nightmare. And for me, I would say the reflection is it was nowhere near as bad as I thought it would be. So.
And on that note, we're going to take a quick break and actually pick up that story theme after it. So go out, have a 5-minute break, and then we'll come back in. Thank you very much, everybody. Thank you.